So I can remember years ago when I was a mess when it came to my finances, right? Remind you, I had $30,000 of credit card debt not once but twice in my life. I won't talk about the first time, but I'll talk about the second time. And I remember, like, as the debt started to accumulate, there were so many things that would I would say to rationalize how I would eventually pay off this debt, or I would use the debt. I would buy things, and eventually I would say, all right, since I have a job, so I'll make sure I'll pay this off at the end of the month, or I'll pay this off in 2 months, or whatever. I'll find some way to rationalize or justify me using this, accumulating this debt. And the problem with that is that things pop up, right? Where there's an emergency, or you lose your job, or you quit your job, or for whatever reason, whatever plan you had doesn't really go according to plan. And I can remember things going up, and I remember as the debt started accumulating, I remember I quit my job, and then it took me longer to find a job. I found a job, and then I was able to make payments on it, but then I left my job for another job, and just things didn't work out. And eventually it got to a point where it just, my debt was $30,000, and you're like, yo, what the hell happened? It happened so quickly, right? And you're like, yo, you can see it happen, but in your mind you're justifying that eventually you will pay it down. And it gets to a point where you get tapped out, and then you get sent to delinquency. Collections are after you, and eventually you're in a financial mess. And this is what's going on today, where people are spending their credit cards. They're using credit cards. They're using buy now, pay later. They're using all forms of debt to justify the things that justify their spending habits. And eventually it gets to a point where you're tapped out. And the good thing is that right now, because people have jobs, right? Even though I think layoffs are starting to pick up now, companies are starting to lay off more people, and I think the layoff rates, layoffs are starting to pick up. It gets to a point where people are going to say, all right, as long as I have a job, I can make these payments. But if they start laying people off and more people start getting unemployed, then you're going to see delinquency rates increase, and you'll see that in the Wall Street Journal, that article I'm about to read. But for a lot of people, things are starting to turn in terms of being able to make their payments on a credit card. So that leads me to this article that I've seen on the Wall Street Journal, and it says credit card debt is up, and it's taking longer to pay down debt. To pay it down. So people are taking much longer to pay down, and for whatever reason, there's a reason why that's happening. Either they're accumulating too much debt and they can't pay off the balance, which is something that you're supposed to do. Especially when I use my credit cards, I make sure to pay that balance off every month. I'm much more responsible when it comes to my finances. But for some reason, a lot of people are struggling to do that now. And as long as they have their job, they can make those minimum payments, even though they're paying a lot of interest on that debt. But it gets to a point where you're going to get tapped out, and you're not going to be able to make this payment, and you're gonna be in a continue your financial mess. So let me read this article real quick and see what's going on. So it says, all right, so the title is credit card debt is up, and it's taking longer to pay down debt, right? Customers of biggest U.S. banks have steadily increased unpaid balances. So it says, from fuel and groceries to hotels and airline tickets, consumers are putting more purchase on credit cards and taking longer to pay them off. The four biggest U.S. banks have reported higher credit card spending in 2023 compared with the previous year. In fact, since 2020, credit card spending has steadily increased at three of the four. The exception is Citigroup, where credit card spending hit a recent peak in 2021. JP Morgan Chase, the nation's largest bank, credit card spending was up 9% in 2023 to 1.2 trillion. At Wells Fargo, spending was up 15%. And there they give you a graph where you can see the credit card spending volume, right? Right. So, and it says delinquency rates have also been on a steady rise since 2021, and you can see this graph right here, where you can see that delinquency rates go down in 2021 from 2019, but now they're steadily climbing back up in 2023. So you can see the delinquencies increasing now for whatever reason. All right, so it says, customers aren't paying off their charges as quickly as they used to. Credit card loans or unpaid balances on accounts jumped 14% as JP Morgan, compared with a year earlier at 9% at Bank of America. Credit card loans were also up at Citigroup and Wells Fargo. And it says, in aggregate, credit card loans at the four banks grew faster than spending in 2023. The unpaid balances also surpassed 2019 levels for the first time, showing that consumers are putting more purchases on the cards and taking longer to pay off their bills than they were before the pandemic. So you're telling me that credit card balances are increasing faster than spending. That's crazy. right? These balances are increased. You should be spending that. You should be paying those balances off, right? So if you ever get to a point where your balances are increasing more than you're spending, then you can see there's a problem, right? It just means that people are taking longer to pay off their balances, right? So in theory, this is good for the banks and that charge interest on consumers who carry a balance. But rising card balances could be a sign that worsening financial plan for consumers and the economy. Considering the fact that interest rates on credit cards are I think average of 20%. That's ridiculous. If you're paying 20% on your credit card balance, you are just giving away money, right? Imagine if you had an investment and you were getting 20% return on that. You'd be killing it with your investment. So, but you're giving that money instead of getting that money in your investments, you're giving that money off to these banks. So they're making a boatload of money off of consumers that aren't being responsible when it comes to their finances. So it says, while banking executives maintain that consumers today are fine, pointing to a strong labor market as a sign that they can pay off high credit card balances, rising delinquencies could indicate that consumers are struggling to pay higher bills. Like I said, as long as people have their jobs, they're going to be making these payments, even though they're going to be paying high interest rates on these credit card balances. As long as they have their jobs, they're going to be able to make these payments. If layoffs happen, where a lot of people predict, depending on how the economy goes, and if and layoffs continue to uptick the way they're doing it, you're going to see delinquencies continue to increase. And that wouldn't be good for the economy. So it says consumers have been spending more than they're taking in, said JP Morgan Chief Financial Officer Jeremy Barnum during the earnings call with analysts. It will be important to see how they adjust in 2024 as cash buffers previously padded the pandemic stimulus checks and student loan pauses are spent down, Barnum said. Consumers' deposits at 4 banks declined in 2023 at JP Morgan. Deposits in the consumer banking unit were down 3%, while deposits in Citigroup's U.S. consumer banks fell. Consumer deposits fell 8% at the Bank of America and 9% Wells Fargo. Well, that's because, for a lot of people, they're even for me, like, I don't keep my money in banks, right? I put it in like things like Wealthfront, right, where you get a higher interest rate, and they're paying like 5%. So you're getting more money by keeping it in a place like that rather than your bank where they're giving like barely 1%. So I think for a lot of people, that's the case. And it says right here, it says the deposit decline is partly from customers moving their money to higher yield alternatives. Wells Fargo executives said still they acknowledge that lower income households are feeling squeezed. So like I said, people are taking much longer to pay down their debt, their credit card debt, and this is not a good sign for the economy, right? If people are racking up, there's an article that was talking about how credit card debt reached $1 trillion. All right, $1 trillion. So people are racking up the credit card debt, and not only that, but they're using. If they're tapped out in the credit cards, now they're using buy now, pay later. You see delinquencies going increasing. So this is not a good sign for those that are struggling with their finances, and then you got inflation going on. So this is not a good sign. So it's going to be interesting to see where this goes, especially if when it comes to more companies laying off, to see how much delinquencies increase. So so let me know what your thoughts are. Leave a comment down below, hit the like button and share. And if you haven't done so already, make sure to subscribe. All right, so you guys take care and have a good one. Later.